I'm Roy Thomas, Sutton Group Professional Real Estate, Seniors Real Estate Specialist. I'm here today with Mark Kenny from Southport Asset Management, and today we're going to be talking about tax-advantaged income strategies. All right, Mark, so let's look at a situation where a retired couple has sold their house. Let's say they've received $400,000 in equity from the sale of the property. They've maxed out their tax-free savings accounts, their RRSP, but they're looking to have that money to produce a monthly income for them. Can you talk about what their options would be to do that?
Sure. It's a very common scenario that's arising today. One of the things that the investment industry has designed, specifically in the mutual fund industry over the last 15 years, is a tax-efficient income strategy that allows investors, and in this case husband and wife, to invest money, produce an income, but be taxed at a much lower rate than any other traditional types of investments, such as guaranteed investment certificates in a GIC or in any type of stock or bond. And the way they do that is over time, there is, and obviously in accordance with Canada Revenue Agency, the ability to defer a lot of the taxation to much later in life. And the advantage of that is, for those people that are drawing old age security or other forms of pension benefits, it allows them to stay at a low marginal tax rate and get the most tax efficient income out of that investment.
So my understanding is someone was to invest $400,000, they would receive an income in the range of $2,000 per month from that money.
Yeah, that's a great assumption to make. The receiving of the $2,000 a month and that actually physically going into their bank account is totally accurate. What their actual tax liability on that money is significantly less. And in the strategy that we talk about, in the first 20 years, it's roughly 80% of that income is what's deemed return of capital, and the rest is deemed either capital gains or dividends. Ergo, 80% of that income is not taxed in the hands of the investor.
So they're going to pay tax on about 20%, give or take.
Correct.
Okay. What else can you tell us about this strategy? Like, what would be the, other than the tax-free or low tax advantage, what else would be the main benefits of it?
Yeah, I think for the most part, what you get to see is in the scenarios we have example would be a husband and wife, and they're receiving this income because most of these accounts would be held jointly when there's spouses involved. You do have the advantage to, or the ability to split that income between the two spouses, which even creates more tax efficiency. The second part to that, when it's held jointly, in the event that one of the spouses predeceases the other, that income will continue as long as one of the account holders still remains. So it doesn't interrupt the income flow for that individual. And it doesn't create a taxable event in the event that one of the spouses passes on. So from an estate planning and a tax efficiency, it's a wonderful strategy for people to get very high level of tax efficient income invested in portfolios that would match the risk that they would have as an individual investor, and to have a future planning perspective to make sure that that money and that income is continued even in the absence of one of the spouses due to a premature death.
All right, now obviously seniors are concerned about risk.
Sure.
So does this program, this plan have the ability to raise or lower the risk so you can match whatever risk level they have accordingly?
It does. You can have the most conservative portfolio established to the most aggressive portfolio established. The only difference is not necessarily in the income stream that you would achieve. What the difference is in the potential market value of your account. Some investors may experience growth in their account, whereas some may just experience the income only, and their mandate may be to preserve their original deposit.
Okay, sounds good. Is there anything else you think we should add to that?
No, I think that that covers it. It really does depend on a number of other factors in the person's individual financial plan, other sources of income, their current tax rates that they have, as to what may be income split, the type of investment they might hold, and what the overall tax advantages of that might be.
So the best thing for somebody to do would be actually sit down with a financial planner and look at what exactly is the best thing for them.
Absolutely.
Excellent. All right, Mark, look, thanks very much. If someone wanted to get a hold of you to discuss this further, what would be the best way for them to reach you?
Sure. Our office is on Joseph Howe Drive. We do have a toll-free number, which is 877-446-5763, and our website is www.southportasset.com. Please feel free to contact us through any one of those avenues.
Excellent. We'll put Mark's contact information down below in the notes, so just go down there and get the information. Feel free to reach out to Mark and just tell him you saw in the video and you'd like to get some more information. Thanks very much. Don't forget to like and subscribe to be notified of future videos on this channel, and thanks for watching. Have a great day.